Something significant is happening right now for a very large group of UK pensioners, and many of them have not yet been told what it means for their income, their benefits, or even their eligibility to claim certain government support. If you were born in the 1940s, 1950s, or 1960s, then the changes being confirmed and rolled out by the Department for Work and Pensions this year affect you directly. Some of these changes are already in motion. Others are taking effect in the coming weeks and months. And the detail that often gets overlooked is just how differently these changes apply depending on your exact year of birth. We are going to go through all of it clearly today: the state pension increase, the rise in state pension age, what it means for pension credit, and the important knock-on effects that many people simply are not aware of. Stay with us to the end, because some of what we cover towards the middle and end of this video could genuinely affect your household income. It is easy to see a headline about the state pension going up and assume it is good news and nothing further needs checking. And in many cases, the April 2026 increase is indeed a welcome boost. But the picture for those born in the 1940s, 1950s, and 1960s is considerably more complicated than a simple pay rise. This is where confusion often begins. Because running alongside the increase in state pension payments is a significant change to the age at which some people can actually claim their pension in the first place. That change, which began in April 2026 and will continue through to early 2028, affects everyone born from the 6th of April 1960 onwards. If that includes you or your partner, you need to know exactly how it applies to your birth date, and crucially, what effect it has on other benefits you may be entitled to. The stakes are real. For those on low incomes, missing out on pension credit as a result of these changes could mean losing not just the credit itself, but also the automatic entitlement to things like the winter fuel payment, full housing benefit, and council tax support. That is potentially hundreds of pounds a year that families could be missing without realizing why. Let us start with what is already confirmed for the current tax year. From April 2026, the full new state pension rose by 4.8%. This is the highest of the three measures used under the triple lock, which compares earnings growth, inflation, and a minimum of 2.5% each year. The earnings measure came out on top this time, which is why the increase landed at 4.8% rather than the inflation figure of 3.8%. In practical terms, the full new state pension is now worth £241.30 per week in the 2026 to 2027 tax year, up from £230.25 the previous year. That is an increase of just over £11 per week, or roughly £572 over the course of a full year. For those on the older basic state pension, typically people who reached state pension age before April 2016, which includes many born in the 1940s and earlier 1950s, the full rate has risen to £184.90 per week. It is worth noting that not everyone receives the full amount. Your state pension entitlement depends on your national insurance record. In many cases, people receive a reduced amount because they have gaps in their contributions. If you are unsure of your entitlement, you can check your state pension forecast through the Government Gateway Service online. Now, here is where the picture changes for those born in the 1960s. From the 6th of April 2026, the state pension age began rising from 66 to 67. This increase is being phased in gradually over a 2-year period, running through to April 2028. The rise is not a single cliff edge that affects everyone on the same date. Instead, depending on your precise date of birth, your state pension age will be somewhere between 66 and 67. With an additional number of months added based on when in 1960 or 1961 you were born. For those born between the 6th of April 1960 and the 5th of March 1961, the state pension age is now 66 years and a specified number of months. For example, someone born between the 6th of April 1960 and the 5th of May 1960 will reach state pension age at 66 years and 1 month. Someone born between the 6th of July 1960 and the 5th of August 1960 reaches it at 66 years and 4 months. The number of months continues to increase in steps for each subsequent birth window throughout 1960 and into early 1961. For those born from the 6th of March 1961 onwards, all the way through to the 5th of April 1977, the state pension age is now set at 67. These individuals cannot claim the state pension until they reach their 67th birthday. Many of the younger people in this group will already have known this was coming, but for those born in the very early 1960s who may have assumed they were unaffected, this is critical information. If you were born before the 6th of April 1960, which covers most of those born in the 1940s and 1950s, your state pension age remains 66, and this particular change does not apply to you. Let us look at how these changes are playing out in practice for some realistic situations. Consider Margaret, who was born in September 1960. Under the phased increase, her state pension age is now 66 years and 5 months. She had expected to claim her pension on her 66th birthday. When she checked her state pension age using the government's online tool, she discovered she would have to wait several additional months. During that waiting period, she had no state pension income coming in. It is worth checking in advance so you can plan accordingly, rather than receiving a surprise when you expected payments to begin. Now consider Brian and his wife Sandra. Brian was born in 1958 and is already drawing his state pension at age 66. Sandra is 63 and was born in 1962, which means her state pension age is now 67. Because Sandra has not yet reached state pension age, the couple are classed as what the DWP calls a mixed-age couple. This is where a detail that many people miss becomes extremely important. Couples in this situation cannot make a new claim for pension credit until both partners have reached state pension age. So even though Brian is already receiving his pension, the couple cannot access pension credit until Sandra also reaches hers at 67. In the meantime, they may be able to claim universal credit, but the rules and amounts are calculated differently. Then there is Jean, aged 74, born in 1952. She reached state pension age at 66 and has been receiving her basic state pension for several years. She was not aware that as a result of her low income, she might also be entitled to pension credit to top up her weekly income. In 2026 to 2027, pension credit tops up the weekly income of a single pensioner to £238, and for couples, the joint amount rises to £363.25 per week. Jean contacted the Pension Credit Helpline, was assessed, and found she was entitled to a top-up payment she had not been claiming. In many cases, a successful pension credit claim can also unlock entitlement to the winter fuel payment, housing benefit, and council tax support. It is worth checking, even if you think you may not qualify. There is another point many people miss, and it relates directly to this year's changes. Because the state pension age is now rising for people born from April 1960 onwards, some people who expected to transition from working age benefits into pension credit will find that transition delayed. If you were previously receiving income support, housing benefit, or similar legacy benefits, and your state pension age is now later than you expected, you may need to claim universal credit in the gap between those legacy benefits ending and your state pension age arriving. Universal credit and pension credit are calculated differently, with different capital rules and different thresholds, so the amount of support available during that gap period could be lower than it would be once you reach pension credit age. Many pensioners are surprised to learn that pension credit can be backdated, but only by 3 months. This means that if you have already reached state pension age and have not claimed pension credit, you could be entitled to up to 3 months of back payments. Every week that passes without a claim is a week of potential entitlement that cannot be recovered once that 3-month window has passed. Another commonly missed issue concerns savings and capital. The DWP assesses savings and investments when calculating pension credit. However, undrawn private or workplace pension pots, money still sitting inside a pension scheme that you have not yet touched, are generally not counted in that assessment. But if you draw out a lump sum from a pension and place it into savings, that money will then count. This is an important distinction that can affect the amount of pension credit you receive. If you are approaching the age where you intend to claim pension credit, it is worth understanding how any decisions about drawing from your pension could interact with your benefit entitlement. Depending on your situation, the rules around capital and savings for pension credit can be complex. The DWP disregards the first £10,000 of savings. Above that amount, a notional income is assumed and added to your assessed weekly income, which can reduce or eliminate your pension credit entitlement. Rules can change over time, so it is always worth checking the most current guidance or seeking advice. There are some straightforward steps you can take right now to make sure you are not caught out by any of these changes. First, check your state pension age. The government has a free online state pension age checker at gov.uk. You simply enter your date of birth, and it will tell you your exact state pension age and the date on which you can begin claiming. Do not assume it is 66. If you were born in April 1960 or later, that assumption is now incorrect. Second, check your state pension forecast. Also on gov.uk through the government gateway, you can view your current national insurance record and see what state pension you are forecast to receive. If you have gaps in your national insurance contributions, it may be possible to pay voluntary contributions to increase your entitlement. Deadlines and eligibility rules apply, so it is worth checking sooner rather than later. Third, if you have already reached state pension age and have a low income, check whether you are entitled to pension credit. You can do this using the pension credit calculator on gov.uk or by calling the pension credit claim line on 08000991234. Lines are open Monday to Friday, 8 a.m. to 6 p.m. Remember that a successful pension credit claim may unlock further support, including the winter fuel payment, housing benefit, and council tax support. Fourth, if you are part of a couple and one of you has not yet reached state pension age, check whether you are classed as a mixed-age couple and understand what benefit options are available to you in the interim period. Universal credit may apply, but the rules are different and the amounts may vary. If any of what we have discussed applies to your situation, the most sensible first step is to check your individual circumstances carefully before drawing any conclusions. The rules around state pension age, pension credit, and DWP benefits can interact in ways that are not always obvious. For most people, the April 2026 state pension increase is straightforward and beneficial. But for those born in the 1960s who are approaching or have recently reached their state pension age, it is worth spending some time with the government's online tools or calling the relevant DWP helplines to get clarity on exactly when you can claim and what you are entitled to. If you are uncertain or your situation is complex, for example, if you have a younger partner, significant savings, or gaps in your national insurance record, it may be worth seeking independent financial advice or speaking with a free advice service such as Citizens Advice, Age UK, or the Money and Pensions Service. These organizations can help you understand your rights and entitlements without any cost to you. Do not delay unnecessarily. In many cases, benefits cannot be backdated beyond a limited period, and every week without a claim is a week of potential income that cannot be recovered. To bring everything together, here is what the DWP has confirmed for 2026. The full new state pension has risen by 4.8% to £241.30 per week, the highest increase under the triple lock in several years. The older basic state pension has also risen to £184.90 per week. These increases apply automatically if you are already in receipt of your state pension. From April 2026, the state pension age began rising from 66 to 67. If you were born from the 6th of April 1960 onwards, your state pension age is now above 66. The exact date depends on your month of birth, and anyone born from the 6th of March 1961 onwards will need to wait until age 67. This increase will be fully phased in by April 2028. Pension credit has also been uprated for 2026 to 2027, with the single-person threshold now standing at £238 per week and the couple rate at £363.25 per week. Over 1 million eligible pensioners are estimated to be missing out on pension credit each year, so it is worth checking your entitlement, regardless of whether you think you qualify. Mixed-age couples, where one partner has reached state pension age and the other has not, cannot make a new pension credit claim until both partners have reached their respective state pension ages. Universal credit may be available in the interim. The detail that often gets overlooked is how these changes connect. A delayed state pension age means a delayed transition to pension credit, which means a gap in entitlement to other linked benefits. Being aware of those connections is the first step to ensuring you receive everything you are due. We will be continuing to cover all the latest changes from the DWP and the state pension system throughout the coming weeks, including any further updates on benefits, winter payments, and retirement income that affect people in the UK. If you found this video useful, please do consider subscribing to the channel. We post regular, straightforward updates on pensions, DWP news, retirement savings, and government support for people at or approaching retirement age in the UK. There are no complicated financial products and no pressure ghee, just clear, honest information to help you make the most of what you are entitled to. Thank you for watching, and we will see you in the next video.